Stock. A stock is part ownership of a company. Share. A share is one single unit of stock. Shareholder. A shareholder is a person who owns shares in a company. Ticker symbol. A ticker symbol is a short code used to identify a company's stock. Exchange. An exchange is a marketplace where stocks are bought and sold, like the Nasdaq and New York Stock Exchange. Public company. A public company is a business whose shares are traded on an exchange. IPO. Initial public offering. An IPO is the first time a company sells shares to the public. It lets the company raise money and gives investors a chance to buy in early. After the IPO, the stock trades freely on an exchange. Index. An index is a group of stocks that tracks market performance, like S&P 500 track the top 500 companies in the US. Security. A security is a financial asset like a stock, bond, or option. Market price. Market price is the price of a stock right now. Market cap. Market cap is the total value of a company's shares. Companies are often grouped as small cap, mid cap, or large cap. This shows the company's size and helps investors compare risk levels. Capital. Capital is money used to start or grow a business. Volume. Volume is the number of shares traded in a given period. Bid price. Bid price is the highest price a buyer will pay. Ask price. Ask price is the lowest price a seller will accept. Spread. Spread is the difference between the bid and ask prices. A small spread means the stock trades easily with many buyers and sellers. A large spread means fewer trades and higher costs to enter or exit. Dividend. Dividends are company profits paid to shareholders. They can be in cash or extra shares. Some companies pay regularly, while others reinvest profits for growth. Bond. A bond is a loan investors give to a company or government. Asset. An asset is something valuable a company or person owns. Commodity. A commodity is a raw product like gold, oil, or wheat. Yield. Yield is the income return on an investment, usually shown as a percentage. Leverage. Leverage is using borrowed money to increase investment size. It can boost profits if prices move in your favor, but it also increases losses if the market turns against you. Inflation. Inflation is the rise in prices that lowers money's buying power. Profit margin. Profit margin shows how much profit a company keeps from sales. Return on investment, ROI. ROI is how much profit you make compared to your investment cost. Bull market. A bull market is when prices keep rising over time. Bear market. A bear market is when prices keep falling over time. Volatility. Volatility measures how much prices move up and down. PE ratio. PE ratio shows stock price compared to earnings per share. A high PE often means investors expect strong growth. A low PE can mean undervaluation or weak future prospects. EPS, earnings per share. EPS is profit divided by the number of outstanding shares. Common stock. Common stock gives ownership and voting rights in a company. Preferred stock. Preferred stock gives fixed dividends but limited voting rights. Blue chip stocks. Blue chip stocks are large, stable, and trusted companies. They usually pay dividend. Growth stock. Growth stocks belong to companies expected to expand fast. Instead of paying dividend, they reinvest to grow. Value stock. Value stocks are considered undervalued compared to their worth. Penny stock. Penny stocks trade at very low prices and carry high risk. Day trading. Day trading means buy and sell in the same day. Swing trading. Swing trading means holding stocks for days or weeks for profit. Buy and hold. Buy and hold is keeping stocks long-term to grow value. Short selling. Short selling is betting a stock's price will drop. Going long. Going long means buying a stock expecting its price to rise. Margin trading. Margin trading is using borrowed money to trade stocks. Value investing. Value investing is buying undervalued stocks for long-term growth. Growth investing. Growth investing is buying stocks of fast-growing companies. Averaging down. Averaging down is buying more when price falls to lower cost. Fading. Fading means trading against the current market trend. Market order. A market order buys or sells at the current price. Limit order. A limit order sets a specific buy or sell price. Stop loss order. A stop loss automatically sells when price falls to a set level. Good till canceled order, GTC. A GTC order stays active until canceled by the trader. Day order. A day order expires if not filled by market close. Fill. A fill is when an order is completed in the market. Liquidity. Liquidity shows how easy it is to buy or sell quickly. Revenue. Revenue is the total money a company makes from sales. Profit. Profit is revenue left after removed costs. Earnings call. An earnings call is when companies share results with investors. Guidance. Guidance is a company's forecast for future performance. Balance sheet. A balance sheet lists assets, debts, and shareholder equity. Liability. A liability is money a company owes to others. There are short-term and long-term. Book value. Book value is company worth based on assets minus liabilities. PB ratio. Price-to-book ratio. PB ratio compares stock price to book value per share. Intrinsic value. Intrinsic value is what an investment is truly worth. It's based on company fundamentals like profits, assets, and growth. Different investors may calculate it differently, making it subjective. Correction. A correction is a short drop of at least 10% in prices. It's often temporary and seen as a normal part of markets. Corrections can also create buying opportunities for investors. Crash. A crash is a sudden, sharp fall in stock prices. Crashes often lead to recessions. Recession. A recession is when the economy shrinks for months or more. Recovery. Recovery is when the economy bounces back after a downturn. Bubble. A bubble is when prices rise far beyond actual value, and sooner or later, it bursts. Black swan. A black swan is a rare, unpredictable event with huge impact. Examples include the 2008 financial crisis and the COVID-19 market shock. These events are nearly impossible to predict, but change markets deeply. Dead cat bounce. A dead cat bounce is a brief rise after a sharp fall. Whales. Whales are investors who make massive market moves. Unicorns. Unicorns are private startups valued at over $1 billion. To the moon. To the moon means prices are expected to skyrocket. Tanking. Tanking means prices are dropping quickly. Pump and dump. A scam where prices are pushed up with hype. Pump. Then sold. Dump. Late buyers lose money when prices collapse. Rug pull. A rug pull is when developers abandon a project and take funds. Panic selling. Panic selling is selling fast out of fear of losses. Short squeeze. A short squeeze is when rising prices force short sellers to buy. Long squeeze. A long squeeze is when falling prices force buyers to sell. Ex-Dividend Date. Ex-Dividend Date is the cutoff to qualify for dividends. Record Date. Record Date is when a company checks who gets dividends. Settlement Date. Settlement date is when a trade is finalized and cash moves. ETF, Exchange Traded Fund. An ETF is a basket of securities traded like a stock. It can track indexes, sectors, or commodities. Some ETFs are passive, just tracking an index, while others are active and managed by professionals. Mutual fund. A mutual fund pools money to invest in stocks and bonds. It's managed by professionals and priced once daily. Investors buy or sell at the fund's end-of-day value. Hedge fund. A hedge fund is a private fund using high-risk strategies. They often require very high minimum investments, so usually only wealthy individuals or institutions can join. This makes them less accessible than ETF or mutual funds for regular investors. Index fund. An index fund copies the performance of a market index. It's a type of mutual fund or ETF. Usually have low fees and steady long-term returns. Broker. A broker is a person or firm that helps you trade. Portfolio. A portfolio is your collection of investments. Holdings. Holdings are the assets inside your portfolio. Holding company. A holding company owns shares of other companies. Control stock. Control stock gives significant power over a company's decisions. Diversification. Diversification means spreading money across assets to lower risk. IRAs, individual retirement accounts. IRAs are U.S. retirement savings accounts with tax benefits. 401k. A 401k is a U.S. employer-sponsored retirement savings plan. Dollar cost averaging. Dollar cost averaging means investing fixed amounts regularly, regardless of price. Compound interest. Compound interest is earning interest on both money and past interest. For example, $1,000 at 10% becomes $1,100, then $1,210, and so on. Over time, compounding grows wealth much faster than simple interest. Technical analysis. Technical analysis studies price charts and patterns to predict moves. It focuses on trends, support, resistance, and trading volume. Traders use it for short-term entry and exit points. Fundamental analysis. Fundamental analysis looks at company health to judge stock value. It reviews profits, assets, debts, and industry position. Investors use it to decide if a stock is overvalued or undervalued. Efficient market hypothesis, EMH. EMH simply says no one can beat the market because stock prices already reflect all known information. Supply and demand. Supply and demand set prices based on buyers versus sellers. Insider trading. Insider trading is buying or selling using secret company information, and it's illegal. If you like this video, subscribe for more, or suggest a topic want to discover in the comment section below.